Welcome back, options traders, and this is a Facebook trading tutorial to continue here with our Facebook trading group for Greek week. And today we're going to tackle our third Greek on the list, Theta. By now you know where all these Greeks are coming from. They are outputs from a pricing model. Here's a screenshot of the one I've been using from the CBOE, Chicago Board Options Exchange, and right down here is Theta. The CBOE chose to use a 7-day Theta, and some platforms will do that, which is close enough to a 1-day Theta multiplied by 7. The reason that some platforms do this is that traders sometimes say, I'm not real worried about the few pennies that my options price is going to decay away each day. I'm more concerned with what's going to happen at the end of the week. So that's why they'll put it into a 7-day term. But the concept is exactly the same. So remember, all of your Greeks are sensitivity measures. Greeks show how sensitive option prices are to various factors. There's one exception, which is gamma. We talked about that yesterday. Gamma shows how sensitive our options delta is to changes in the stock's price. But with that exception out of the way, all of your other Greeks talk about the sensitivity of your options price. We all know that option prices decrease as time passes. Well, that's good information, but would it matter to you if your $10 option was going to lose 10 cents tomorrow or $9? Yeah, I'd kind of like to know. So it's not enough to understand that an option's price will decay over time. What we really want to know is by how much, and Theta gives the answer. Theta is easy to remember. It's the Greek letter T, and it was chosen to represent time. So Theta shows how your option's price will respond with the passage of time. So why is there a Theta anyway? Well, options are called wasting assets, and that just simply means that a portion of its price is going to decay away with each passing day. Theta is given in dollar value loss per day. That's how you'll see it on your broker's platform. So for example, a Theta of 0.07 means a 7-cent loss per day. As I've mentioned in previous videos, some platforms might multiply that number by 100 because each contract controls 100 shares. So they might show it as 0.07 or they might show it as 7. But most of them show it with a decimal, but just in case it doesn't, understand what it means. It's critically important to understand that this number, whatever it is a rate of loss. It is a rate at that moment in time. And I'll talk more about that a little bit later in the video. But the important point right now is that just because you see, let's say, 7 cents per day, doesn't mean you can say I'm going to lose 70 cents over the next 10 days. Like all of your Greeks, it is a specific measure at a moment in time. So we have to be careful about the interpretation. Another important fact is that only the extrinsic value decays, or the time value. So if you have an option that is rich with intrinsic value, you shouldn't worry that the entire options price is going to decay with the passage of time. It's not. Intrinsic value is not decayable. It is only the extrinsic value that decays. So let's take a look at an example. Let's say you've got an option that's trading for $3. You look at your broker's platform and it says it has a Theta of 0.07. What that means is that with the passage of a single day, that option's value should decrease by 7 cents, and the new value will be $2.93. Why do I say should decrease? Because like all things with Greeks and options pricing, it assumes that all other factors remain the same. Obviously, if the stock price falls $5, our option's not going to be anywhere near $2.93. And if the stock price rises $7, it's going to be a whole lot more than $2.93. If volatility happens to jack up, that's going to increase the options price. We have a lot of moving parts. So Theta is assuming, like all Greeks, that all other factors remain the same. But it's still a very helpful measure because at least it tells you how much of that options price is being exposed to time decay. What Theta measures is the rate of change between two different profit and loss curves. For those who aren't familiar with profit and loss curves, I do have a video in here in this Facebook group, but let me give you a little recap here because you have to understand the basics to understand what we're going to be measuring here. First of all, look at the curve in yellow. That is what's called an expiration graph. And that's what in this case, it's a $50 call. And I know that because we have a bend right here at 50. We always get a bend at the strike. So this is going to show us what happens to our options value at expiration. And by expiration, I mean within the, let's say, final 10 seconds of trading. I don't mean a day from now or 3 days from now. I'm talking just in the final seconds. And that's when you're really allowed to use that yellow curve. So for example, here's the way that you use the graph. We're coming into expiration. I've got this option. I want to know what my value is going to be if the stock is 55. I find 55 on the horizontal axis. I trace a line up to the yellow curve, and I look left. It tells me my option's going to be worth $1. What if the stock is 60? Find 60, trace a line up to the yellow curve, look left, it's going to be worth $6. If the stock is 45 down here, trace a line down to the graph, it's going to lose $4. So the yellow line is really just showing us the options value at expiration. Also notice, since we've talked about delta in the previous video, another thing that we're looking at here is if the stock is below 50, my delta will be 0. And that's why this line is flat for all stock prices below 50. On the other hand, if the stock rises above 50, this yellow line goes off on this 45-degree angled portion like we saw in a long stock position. And that's saying that your option will have intrinsic value. Or you could think of it as that people would have the inclination to exercise it and be long 100 shares of stock. So below 50, it's worthless. Above 50, it's acting like stock, assuming we are at expiration. But now let's say we've got maybe 30 days to expiration. We're going to be on this green curve. We work it exactly the same way. So if the stock is 55 today, what's my option worth? I find 55, trace a line up to the green line, and it says $4. Why was my option worth $1 at expiration, but is worth $4 today? The only reason is that time remains. It's because there's $3 of time value. And so what you're looking at here, the difference between the green and yellow lines, this little space right here, is the value of time. So as time goes by, that green line starts to move towards the yellow until the expiration bell rings, in which case it's exactly on that yellow line. So here's the way that theta is being calculated. It says, what's the options price right here at the current stock price, and what will it be tomorrow? So for instance, maybe our new options curve is going to be down here in red. And that little space between the green and red lines is theta. It's measuring the fall in the options price between two different dates. Now fortunately, we don't have to go and do that. The computer does it for us, but it helps to understand what it's measuring. Now again, remember, very important here, only the extrinsic value is a decayable value. Intrinsic value is not decayable. Remember that the intrinsic value is the amount by which the option is in the money, or what we might call an immediate benefit being conveyed in the option. The extrinsic value, or the time value, is any portion of that option's value over and above the intrinsic value. If there's no intrinsic value, the option's value is entirely extrinsic value. When we get to expiration, all extrinsic value must become 0. That's important. Once that expiration bell rings, we know for a fact every single strike for that month has 0 extrinsic value. Let's take a look at some examples. We'll start with calls. Let's say we've got a stock trading for 100 and the $95 call is trading for $5.50. How much intrinsic value is there? Well, think about it. If I own the $95 call, I have the right to pay $95, but the stock's worth $100. Well, it sounds like there's kind of an advantage of $5 to me right there. And there is, and we have to pay for that. We know that that call has to be trading for at least $5. So the intrinsic value for a call, we take the $100 stock price, we subtract off the strike, so we end up with a $5 value here, and that's our intrinsic value. So the $95 call has $5 of intrinsic value, but it's trading for $5.50. And that means the remaining portion, that 50 cents, must be extrinsic value, and that's the portion that's decayable. So if we own this option and we hold it all the way to expiration, and the stock stays right at 100, that option is not going to zero. It is moving towards $5. It's only going to lose 50 cents. Now, just to be clear, is it possible we could lose the $5? Yes, but that would require for the stock to move to 95 or below. But the passage of time by itself is not going to affect that $5 portion at all. Let's take a look at the extrinsic value for puts. We'll use the same $100 stock here, and let's say we have a 110 put trading for $10.20. Well, again, you have to think about it backwards now, but if I own the 110 put, I have the right to sell shares for 110. But wait a minute, they're trading for 100 in the open market, but I can sell them for 110. Well, it sounds to me like there's a $10 benefit being conveyed in that option. And there is. That's the intrinsic value, and it never comes for free. You got to pay for it. So if I know the stock is 100 and I'm looking at the 110 put, I know for a fact it has to be worth at least $10. So for put options, to find the intrinsic, we take in this case, the 110 strike, we subtract off the $100 stock, and we find that there is $10 of intrinsic value. But because the option is trading for $10.20, there's an additional 20 cents in that option's price. And therefore, 20 cents must be extrinsic value, and that's the portion that's decayable. So if this option sits here between now and expiration and the stock price stays at 100, we're only going to lose 20 cents from time. What would it take to lose the $10? Stock price would have to rise to 110 or above. But the passage of time by itself is not going to affect that $10 intrinsic value. Now, it's critically important to understand that theta is a rate of change. I mentioned this earlier in the video. Got a 7-cent theta. Don't multiply it out by 10 and expect to be accurate. Depending on the conditions, it might be close, but in some conditions, it could be vastly far off. It's only a rate of change good for right now. Like all of your other Greeks, it's going to change as the stock price changes, as volatility changes, as time changes. It will always change. So here's a good kind of an analogy. Let's say we got our race car sitting at the start line right here, not moving at all. And at the end of the track, he's going to be doing 120 miles per hour. Well, obviously, he's accelerating through that entire zone. But let's say we're sitting off to the side right here with a radar gun, and right when he passes that spot, we hit him with the radar gun, and the radar gun says he's traveling at 40 miles per hour. Well, if I take that 40 and I say, well, that means in an hour from now, he's going to be 40 miles down the road. Is that true? Assuming he keeps going at this rate, he is going to be way beyond that. Yes, he was traveling 40 miles per hour at that one snapshot in time. But 10 seconds later, you're going to be way off. And the further you try to project that distance using 40 miles per hour as your base, the further off you're going to be. And that's exactly what will happen if you say, my theta is 7, and therefore in 10 days it's going to be 70, and keep multiplying it out. It's not going to work. And I see a lot of people do that, and it causes major errors. It is a rate of change right now. Let's take a look at some key theta characteristics you need to understand. Characteristic number 1, for any given month, theta is going to be the highest for the at-the-money options. Now, why is that? Well, at-the-money options fall at a faster rate. Visualize it. Take a look at this. Let's say that we have an at-the-money option trading for $3. Because it's at the money, there's no intrinsic value. That's all time value. But we also have an in-the-money option. Yes, it's going to be a more expensive option. Might be trading for $10 or $12. But there's only $1 worth of time value. And so the other thing that we know is that both of these options' time values must hit 0 at expiration. So think of this like a graph. The $3 value is much higher on the graph because it's a higher time value. The $1 time value sits much closer to 0. What does that tell you? If both of these time values must reach 0 at the same point in time. The only way they can do that is if the at-the-money falls at a faster rate. So that's a good way to conceptualize why that must happen. It's because all of your options must have their extrinsic value hit 0 at the same point in time. Theta characteristic number 2, theta decreases as you move away from at the money in either direction. So I've got my at the money option, has a certain amount of time value. As I go deeper in the money or deeper out of the money, theta is going to decrease. So for example, let's say I'm looking at June 70 calls theta. With 30 days to expiration, theta might be 2 cents. With 25 days to expiration, theta might be 3. With 20 days might be 4.5 cents, 15 days 6.5 cents, 10 days it might be 9 cents, and finally with 5 days, theta might be 12. So notice that it increases with the passage of time. And again, sometimes traders just think it just means that more of the option's price is coming off, and that's true, but it's the rate at which it's coming off that's accelerating. So this is important for all of the option sellers out there, especially people doing covered calls, vertical spreads, condors, butterflies, anything like that where we're trying to capture this extrinsic value. All things being equal, you should ride those strategies closer to expiration. Because if you thought it was easy to make the first 2 or 3, 4 cents, wait until you pass another week. Be the easiest money you've ever made. But that doesn't mean it's for free, because we're going to have gamma increasing. We might have issues with vega. And those are all things we can change depending on the strategy. But at a minimum, understand if you are involved in premium collection strategies, all things being equal, you should try to ride those closer to expiration. Theta is the reason. Theta characteristic number 3. Theta is the highest in your front month and decreases as time to expiration increases. For example, let's just take a look at the 70 strike calls. If I'm looking at the June 70s, theta might be 0.0285. If I'm looking at July 70s, might be 0.0207. August might be 0.0172. September might be 0.0151. Notice that they are decreasing as I go out in time, assuming I'm keeping the same strike. Now finally, here is a time decay graph, and I'm sure a lot of you have seen these before in books and on websites. The first thing to understand is that this is only good for an at the money option. It does not apply to in the money. It does not apply to out of the money. So let's say that we have a $10 option right now with 100 days till expiration. Most people who are new think that the option would decay in a straight line like this. In other words, when 10% of the time has passed, 10% of the option's price falls off. When half the time has passed, half the option's price has fallen off, and so forth. That's what we would call linear pricing. It's not the way that option prices work. They are actually priced according to the square root of time. So that's what causes this curved, what we call a time decay graph. And what this shows is that when you've got a lot of time till expiration, the option's price will decay fairly slowly. Not going to notice it much at all. However, when you get into this portion of the graph, let's say the last 30 days, and certainly within the final 2 weeks, you're going to start going off a cliff. So it's not a straight line. Instead, it's very, very slow, then it kind of rounds a corner and then goes off a cliff. So I often tell new traders, think of it like green bananas versus yellow bananas with spots. In the early stages, that option's not going to decay much, assuming you've got a decent amount of time till expiration, maybe 6 months, 9 months, or more. Not going to see a lot of time decay. But you get within that 30-day window, 2-week window, it starts to accelerate. And just like anybody who has had yellow bananas like this knows, it doesn't take long for them to radically go off a cliff. And that's what will happen to your options when you get within this window. However, having said that, it doesn't mean it's necessarily bad. Depends on what you're trying to do, and this is where strategies come in. If I'm focusing on time decay for a premium collection strategy, this is a great thing. But maybe I want to push my deltas closer to 1. I'd like to see this. Maybe I want to see gamma increase for a certain reason. I would love to have this property. So it depends on how I want all of these Greeks to interact. And that's really when you become the best at options trading, when you can make all of these Greeks work in a way that is satisfactory to your goals. Now, there's one final point I'd like to show you. It's a neat little trick you can do if you're trying to figure out how much your option's going to be worth at various points in time. I said that options are proportional to the square root of time. So here's the way you figure it out. Let's say we've got this 100-day option, and I want to know what its price is going to be when half of the time remains. I always have to state the question and how much time remains. So I'm going to put that as 0.50, and then I'm going to take the square root of that. It's going to give me about 0.71. And that tells me that about 71% of my options price will remain, or in other words, 29% has fallen off when half the time remains. So take a look down here, 50 days till expiration, and the option's trading for about 707, or about 71% of its value. But I could also flip the equation and say, at what point in time will my options price be in half? So in this case, if I want to know where my options price will be cut in half, that's 0.5, and I will square it, and that's going to give me 0.25. And that means when 25% of the options time remains, or in other words, 75% has passed, that option's price will be cut in half. So look down here, we've got a 100-day option, 25 days remaining. That's 25% of its time remaining. And right there, the option would be trading for $5, exactly half of its $10 starting point. So I hope this helps you to understand the basics of theta. Obviously, there's a lot more. We could go on for hours and hours talking about theta and different uses for strategies. But at a minimum, if you are trying to profit from changes in an option's price, you need to understand options pricing. And to really master that, you have to understand your Greeks. So please keep working with that. We'll hit Vega tomorrow, and then I'll show you a wrap-up class where we'll put all of these concepts together. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course at optionsaToZ.com, or you can instant message me here on Facebook.